CEF Weekly Review Loan, CEF Valuations Deflating with Rates? This article was written by ADS Analytics. Summary: we review the CEF market valuation and performance through the first week of June and highlight recent market action. Loan CEF valuations have underperformed as Fed rate cuts led to distribution reductions, reversing prior outperformance from the hiking cycle. A couple of Nuveen CEFs have trimmed distributions, with few distribution changes elsewhere. We are ADS Analytics, a team of former researchers and trading at several global investment banks. We run the investing group Systematic Income, where we scour all market sectors in our search for attractive, high-yield opportunities. Welcome to another installment of our CEF Market Weekly Review, where we discuss closed-end fund market activity from both the bottom up, highlighting individual fund news and events, as well as the top down, providing an overview of the broader market. We also try to provide some historical context, as well as the relevant themes that look to be driving markets or that investors ought to be mindful of. This update covers the period through the first week of June. Be sure to check out our other weekly updates covering the Business Development Company, BDDC, as well as the preferreds baby bond markets for perspectives across the broader income space. Market action. CEFs had a decent week, with equity-linked sectors outperforming given the continued strength in stocks. Year to date, muni sectors are underperforming as longer-term rates have risen. CEF valuations continue to richen, with the median CEF sector discount now trading around 2% tighter to its longer-term average level. Market themes. Loan CEF valuations continue to lose ground to the broader CEF sector. The culprit is the drop in short-term rates and, consequently, loan CEF distribution cuts. This is a dynamic we highlighted earlier that was likely to happen in a reversal to previous distribution raises. Recall that the Fed hiked rates in 2022. This pushed up loan CEF incomes and eventually drove distribution hikes as shown below. This resulted in loan CEF discounts outperforming in mid-2022 and eventually moving to a tighter level than the broader space around Q3 of 2023. The chart below shows that loan CEF discounts, blue line, were trading substantially wider of the CEF sector average, orange line, in 2022, just as the Fed started to hike the policy rate. As the Fed rate hikes filtered through, loan CEF valuations outperformed the broader CEF market. However, once the Fed started to cut rates last year, our view was that loan valuations would underperform the rest of the CEF market in a reversal of its previous trend. This is indeed what has happened. The chart below combines both relative loan CEF valuations, green line equals loan CEF discounts less the CEF sector average discount, i.e. lower means loan CEF valuations underperforming, and normalized loan CEF distributions, blue line. The cuts in the sector started to come a few months after the Fed initiated the cutting cycle. Loan CEF valuations staged a last hurrah in early 2025. However, since then, valuations have continued to deflate, now trading slightly cheaper than the broader sector. This dynamic highlights that the CEF market remains somewhat inefficient, and many investors in the sector tend to be distribution trend followers, i.e., they pile into funds with a recent history of distribution hikes and vice versa. This can work okay at the beginning of the trend, but leaves investors exposed once the trend turns. Rather than chasing distributions, and understanding how CEF distributions are likely to evolve over the medium term will likely deliver better results. Market commentary. In CEF distribution news, Nuveen Funds NPCT and NMAI trimmed their distributions by about a tenth. NMAI also moved from a quarterly to monthly distributions, a trend we have seen over the past few years to align with the demands of retail investors. BlackRock had small adjustments for their managed distribution funds BSTZ, BTX, BMEZ, BCAT. Eaton Vance made incremental changes for EVR, EFT, EVV, and EVG, with the last two up slightly. There were no changes from Invesco, John Hancock, Guggenheim, or PIMCO. Loan/CLO Equity CEF held its regular quarterly update. The fund pointed to spread compression as being a key factor behind the drop in income and, by extension, the recent distribution cut. Management said that loan spreads tightened almost 0.3% over 2024 and an additional 0.1% in the early part of 2025. This puts loan spreads at post-GFC tights. An imbalance in loan supply and demand was partly responsible for spread compression, as well as positive market sentiment, notwithstanding the moves in April. Overall, the fund remains an attractive way to hold some CLO equity exposure, given its relatively low fee structure. There are no incentive fees and the lowest leverage cost in the sector. Stance and takeaways. Distribution cuts in the loan sector have seen some air pockets across a number of funds, such as EIC and less so XFLT. Investors disappointed by recent distribution cuts are dumping positions, creating attractive entry points for others. Both funds remain attractive holdings in the CLO CEF sector due to their relatively low management fees, high income levels, and strong historic returns. This article was written by ADS Analytics